Rate hikes were expected but are now paused. Markets have been bumpy given nervousness about rates and questions about the recession that hasn't happened. People are still using rates in vehicles that are too low in cash. That and other topics today in the advisory group's quarterly context webinar. Welcome to the quarterly context webinar for this third quarter of 2023 for clients and friends of the advisory group. I'm Greg Patterson, CEO. For those familiar with the advisory group, and for those that are not, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realm, their fiduciary roles with retirement plans, which also include as fiduciaries in their communities through foundations and endowments. We do these presentations to help provide and make economic and other information approachable and hopefully interesting, high-level perspective regarding the economy, markets, and investor behavior patterns to help clients stay more relaxed by staying more informed and make better decisions towards your goals. We'll keep this to about 20 minutes, maybe a few minutes over, and we'll circulate a video link should you like to view it again or pass it on to someone that you think we can help like we've helped you. If you have any questions, please drop them into the question box and we'll answer that as we go along or at the end. As always, we cover some of the similar topics with updates regarding the data and information. We'll also be talking about the current bond environment and the duration effect and the short-term money dynamics mentioned a moment ago. As always, we encourage people to think about and focus on that space that overlaps between things that matter and things that you can control. You can't control the economy or markets. For example, you can control how you respond to it and how you develop a long-term strategy to deal with it relative to your goals and needs. News is always something that causes bumps as we go along. Rates and auto worker strikes and other dynamics have led to a bumpier quarter this quarter with a negative return for both stocks and bonds. But in the long run, the news smooths itself out, as do markets. A few key metrics, an additional rate hike a little while back brought rates up a total of 5.5% to a 5.25 to 5.5 range. The fastest and steepest sequence of rate hikes, which had a negative impact on bonds over the last 15 months. We'll talk more about the other side of that coin today as well. The inflation numbers, inflation cooled a little bit further down to 3.7 versus the prior quarter and versus the 9% return. It shows 4.9 here, but that should read 9% of June 2022 at its peak. Both stocks and bonds were down about the same percent this quarter, given that uncertainty about rates and whether or not rates would go up. But the Fed just signaled today that they are planning on pausing interest rate hikes rather than increasing, and that should give markets a little bit of confidence. That's coming out of data from the Fed. The Fed feels like inflation and other dynamics are increasingly under control, but they want to be careful and are signaling that there will be an extended period of elevated rates, but it's unclear what extended means exactly. The Fed will take a wait and see approach as the economy evolves. Unemployment went up a little bit, but still hovering around long-time lows. Gross domestic product, or GDP, growth of the economy has been hovering around a solid 2%. And interestingly, almost a 5% increase is expected for the final numbers that come out for the third quarter. Value and growth in small cap. Value did better by falling less than small cap growth. A good reminder that within asset classes, diversification is valuable. These charts here and the arrows show an interesting story. Red numbers across the board, stocks and bonds during the quarter, given the dynamics mentioned a moment ago. But if you look out just 1 year, you would be amazed to think that that these numbers are all connected to the same year. very strong returns in a number of asset classes over the year, as well as 5 years and 10 years, with bonds being weaker given that rates were at all-time lows for an extended period of time. We look at longer term numbers. We can see the 10-year annualized numbers that look very positive. And just looking at this, you wouldn't know that the COVID period happened or that the interest rate hike period happened and so forth. And even in this last year-to-date period, a little bit less than a year, 3 quarters, one negative return slightly, basically flat, and some segments of the market very strong. So these different segments of the market take turns and combine, provide diversification over time. The long-term chart, if we go way back to say 15 years, but looking at other periods of 15-year periods going back, including the 30s, the 70s, the 2000s, show how the current market with the global financial crisis, the COVID dip, and the interest rate hike dip is still on an inflation-adjusted basis far above the other 4 worst markets and their respective recoveries. Stock valuations are still a little bit above average, cooled a little bit, and the closer markets are to the average or below average, that implies oftentimes that future returns will be stronger. You can see that the price earnings ratios as a measure of valuation has been steeper or possibly more stretched in the large cap growth area. That's where a lot of the mega cap tech stocks like Google, Microsoft, and others lie, have had stronger returns over the last 10 years in a lot of categories, but oftentimes when there's an extended period like that, that can reverse, and areas that have had lower valuations then oftentimes bounce back. And again, a great illustration of where opportunities lie and importance of not getting too excited about what's been doing hot recently. Also, we can see valuations have generally cooled or normalized across the world, which implies more positive returns in the future as that normalizes back up. The yield curve, which shows the short-term rates relative to long-term rates of bonds, has shifted up in the longer end while staying the same at the lower end, and that's oftentimes referred to as a bear steepening, which is unusual. It doesn't happen very often. However, it does oftentimes coincide with rate peaks, which would be helpful to know, because as rates start to come down, maybe to stimulate the economy, or maybe as the Fed starts to just try to create additional dry powder for future stimulation needs or rate control effects. Those are some of the dynamics. When it's rising at the longer end, as you can see, it's shifted here, but not shifted here, versus the prior end or the prior quarter, can imply more volatility, which is interesting because generally when people refer to the steepening of the curve, the more common is technically what's called a bull steepener, where short-term rates are falling faster than long-term, and that implies future growth expectations for an economy. So 2 different ways of steepening, which have 2 different messages. So speaking of inverted curves, which we were just looking at, where the short-term rates are higher than the long-term, oftentimes that implies recession. However, the current period of an inverted curve has been going on for around 20 months. Normally, if there's a recession, it happens before that long. So not clear where things are going. A lot of economists still are believing and hoping that there'll be a soft landing. Some are concerned that won't be the case. It would be not quite a soft landing, given that inflation isn't coming down as fast as hoped. Student loan payment resumption is about to start again. Gas prices are up, and those types of factors increase spending requirements and can dampen the economy because the spending would be on a few specific areas rather than broadly, for example, on the student loan, which doesn't really stimulate the economy. Despite some of those concerns, we're now at the lowest rate in a year in terms of economists believing that a recession will happen in the next 12 months. So the lowered view of the chance of a recession. So interesting numbers to see, some mixed messages, and that's part of why the markets have been bumpy. Inflation has continued to cool, albeit gradually, and picked up a little bit, but in a general downward trend, which is what the Fed wants to see. You can see oil and therefore also gas prices have picked up a bit. Rates have been continuing, or you can see here the continued pattern, but now flattening out a little bit. And with the news today that the Fed is pausing rates, maybe that we are at the peak, although we can't tell that until the Fed really determines their comfort level with bringing rates back down. Another view of the rate history, whereas a quarter in the last few quarters, the Fed was projecting that rates would come down about 2% over the next 2 years. Now it's closer to 3% over the next 3 years. So when that happens, that's sometimes because the economy needs stimulation, but that also means that bonds get a boost, and we'll talk about that right now. So when rates go up, new bonds have higher rates, making previous or existing bonds look less attractive. So bonds that are already in the market, the prices drop. That's why we saw that 13% drop in the broad bond market in 2022 and part of 2023. There's a term called duration that is the calculation of the measure of interest rate sensitivity for a given bond duration. Not quite the same thing as bond maturity, but you can still think of it as short term, medium term, or medium intermediate term. And this chart doesn't show long-term bonds. But if you take a typical intermediate term bond fund, it would have a duration of 6 years. And if interest rates go up by 1%, the price or value of that bond portfolio would drop 6%. So 1% change, 6% drop. That's the interest rate sensitivity factor. The reverse is true, however, when rates come down. So if rates come down 1%, that's a bond portfolio with a duration of 6 years would have a return boost of 6%. So recall that I just mentioned that rates are expected to come down almost 3% over the next 3 years. That would be about a 16% boost in bonds, which is significant. So for those that have been disappointed and worried and frustrated with bonds and thinking, hey, bonds don't provide diversification anymore, this has been a very unusual period where there's been really no place to hide. Luckily, not a dramatic major market downturn, but negative returns. But on the horizon, when rates start to come down, the bond portfolio will give a boost, and that will be particularly helpful because when rates are brought down, oftentimes that's a cooling period for equities a little bit, and then bonds should provide the diversification that you would more traditionally see. On a somewhat similar note, there's a lot of people that we see out there and hear about that believe they are getting high rates in cash because rates have gone up to around 5%, the Fed rates. But if it's cash, savings, or sweep vehicles in a brokerage account, you're earning close to 0%. Whereas money market funds are paying about 5%, short-term bonds a little more than that in terms of the expected, 1 year sort of effective return. CDs a little bit more because they have a little premium, but there's a penalty if you have early withdrawals. So oftentimes that doesn't make sense to have the liquidity challenge. So what we encourage people to do is take a look at their money, and if there is excess in cash that isn't needed in a savings or checking account. Of course, checking, you need to write checks, but for money that really isn't needed, that would be more efficiently put into a money market fund where it could be earning closer to or a little bit above 5%. Now, when rates drop, money market rates drop at the same time as rates do, whereas bonds go up. So that's a different money markets. While they contain bonds, the dynamics are different in terms of how they work as an investment vehicle. So don't think of money market funds as being a perfect long-term solution because they're not, and rates will come down, money market returns will come down. So it really should be for short-term money only in the vast majority of cases. Unemployment has come down as mentioned. Wage growth has also come down, which doesn't feel good to the average consumer, but is good news to the Fed, because it means that that can de-stimulate the economy a little bit, which means that they will sooner be able to bring rates back down. Consumer confidence has been in an upward trend, but cooled just a little bit. Savings for consumers has come down after the period, lower spending period during COVID and the individual stimulus payments that went out. Volatility is actually down, although it's picked up a little bit more recently, but not to extreme levels. And as to review this again, because this is an important topic, it relates to timeframes and short-term versus long-term in some of these topics in terms of cash versus longer-term portfolio. Endowments typically break if they're doing things in an effective, strategic way. We'll have different types of portfolios for different timeframes. A lot of individual investors where there's a material spending need on the horizon, it can also make sense to excuse me, have a portion in a shorter term portfolio, but definitely not in sweep, which has that near 0% return. So your advisor can help you figure out how the most efficient structure might be given your needs and timeframes. We also have new blog posts. Take a peek there, something you might find helpful, some things you might see and say, oh, wow, this would be helpful for someone I know. Feel free to forward those and share to help someone else. And we appreciate you joining us here today. We also very much value when you share how we've helped you with others. There are many people out there who are not getting the help that would help them optimize their financial personal life or their endowment structure or their retirement plans. And you can really have a positive impact on people's lives and communities by helping make sure they are getting good help. So feel free to share how we've helped you. Thank you very much, and we look forward to talking to you soon.